Thanks for watching this Magellan update. Today I'm speaking with Gerald Stack, our Head of Infrastructure. Gerald, there's been plenty of geopolitical risks causing a lot of market volatility. What are the risks that you're particularly focused on, and what are you doing within the portfolio to potentially protect some of that capital?
Okay, so there's probably two key geopolitical issues that we're focused on today. One is the UK, where you've got Brexit, and the other is Italy, where we have political and economic uncertainty. So let's deal with the UK first. So in the UK, there's really two types of assets we can invest in. One is GetLink, the tunnel that runs between the UK and the continent, and the other is regulated utilities. Now, the tunnel that runs between the UK and the continent really has three businesses: the transport of people, the transport of cars, the transport of trucks. Now, in the event of Brexit and the uncertainty that that brings, that in the long run, we don't think that fundamentally affects the long run demand for that of the GetLink service. But in the short run, we expect some issues around the way that the Brexit rules work with the tunnel. So we expect some uncertainty. We expect some less than positive operating results in the short term and some uncertainty around that. So that's GetLink. If we think about the regulated utilities, now regulated utilities by and large are not typically caught up in political events, but the situation we have here is that as a result of the uncertainty around Brexit, the population now is saying that it ranks the Labor Party equally with the Tories. So in the event of a snap election, the Labor Party is just as much of a prospect of getting in as the Tories. And that's important because the Labor Party, as part of its manifesto, has said that it will sell the utilities. It will nationalise the utilities, not sell, buy the utilities. And that is important in that they have also said that they will determine the price at which that they pay for that it won't necessarily be market value or even the regulatory asset base, which is perhaps what we might expect, but they'll determine the price, or that Parliament will determine a price, and that could be within a wide range. And therefore you have the prospect that an asset that typically as an investor you're expecting very reliable, fair return, but very reliable return within a narrow range, has now got a very wide range of potentially unfair and fair returns. So for us, we question whether those assets are investable today, those regulated utilities. And what it's meant for our portfolio, the way that we've dealt with that is that we have a very small position in the UK today. We've reduced our position from roughly 8-9% a year ago of our portfolio to around about 1-1.5% today. So we've avoided that as a region for our portfolio. In the case of Italy, what we've got going on in Italy is an economic malaise, political uncertainty, and I guess economic uncertainty as we look forward. And that has meant that for the Italian government that they are batting heads with the EU around what the size of the potential budget deficit would be, and there's a heap of uncertainty around the potential outcome there. And in particular the outcome for Italian sovereign bonds. That's important in terms of the way that we price these long duration assets, infrastructure assets. So for us it's meant that Italian assets comparatively are a much more risky, uncertain potential set of outcomes. Again, wide range of outcomes rather than the narrow range of outcomes we would expect in the infrastructure world. And once again, the way that we've dealt with that is to reduce our allocation to that jurisdiction. Today, our weighting to Italy and also to Europe as a consequence is much lower than it has been historically. So they're the two big issues. Essentially we've tried to avoid those issues to the best of our ability.
And so how has the strategy fared in these more volatile markets?
Okay, so the infrastructure strategy has performed very much in line with what I would regard as our core thesis, and that is that infrastructure should be low beta, it should be certainly low correlation in downward markets. And it should do that because the underlying earnings streams are very reliable, very predictable over time. So investors should have a degree of confidence of that. And that's very much what we've seen play out. We've seen infrastructure fall a good deal less than equities over the last couple of months when the volatility has been around. And our own strategy has done better than that again. So certainly very much the thesis, certainly nothing we would crow about, in that we expect infrastructure to deliver 5% plus inflation over time, and on an annualised basis it certainly hasn't done that in the last couple of months. But if we stand back and look over 5, 10 or since inception, what you see is our returns have been very much in line with that thesis, inflation +5 plus a little bit on top of that. And this short-term market volatility is something we've got to ride through, but we see no reason to believe that today why an investment into infrastructure won't deliver those sorts of returns, 5% plus inflation, perhaps plus a little bit more if we get valuation right over time.
And there's been some volatility in the oil price of late. What's been the impact on the portfolio?
So the short answer to the question is the impact is minimal, if any at all. The longer answer is this is really a function of the way that we define our universe. For us, infrastructure is about delivering very reliable, predictable returns over time. And while infrastructure investors typically define infrastructure by virtue of its physical characteristics, that is assets that deliver essential services, what we do is to say, okay, let's start with that group of assets that provide essential services and let's screen out anything where the earnings are not reliable and predictable over time. And there are three big influences that we tend to be screening out. One is sovereign risk, so for us, no China. The second is competition, so that's sort of no power generation and things of that ilk. The third is no commodity price, so anything where the oil price or the gas price or any other commodity price for that matter has a direct impact upon the earnings, then we're not going to be there. And that we're not going to be there because we just don't believe we have a skill base in predicting where commodity prices are going to be. So by virtue of applying that definition, it means that our investable universe doesn't include those assets that are influenced by oil prices on the way down and also on the way up. It means ultimately that if the oil prices are rising, we may struggle structurally to do as well as our benchmark. However, in these times when oil prices are falling, it's of no consequence to us. And indeed, if we look over the longer term, what we would say is that oil prices are not going to structurally influence the nature of our returns. We expect to be delivering 5% plus inflation irrespective of whether oil prices go up or down.
And so, Gerald, maybe give us a flavour for the current portfolio positioning.
Okay, so if we think about our universe is essentially 60% regulated utilities and 40% infrastructure. Our portfolio is essentially diametrically opposite to that. We're roughly 30% in utilities today, about 60% in infrastructure, about 10% in cash. Utilities for us deliver very stable, reliable returns. If we look over the last sort of 3 years, utilities for us have looked less attractive in terms of valuation. We've started to see that come back to us, and so our allocations are starting to creep up in that area, but it's still underweight compared to our universe. In infrastructure, that's been the place where we've tended to find attractive opportunities. It's in infrastructure where we can identify assets that are going to grow their volumes, whether that's traffic through a road, passengers through an airport, data through a communications network, at strong rates over long periods of time. And given that these assets are regulated at the point of price rather than earnings, think a toll on a toll road which grows with inflation, that's the regulation. Therefore, that means that these assets can grow high and indeed growing returns on capital over time. So that if we can identify assets who've got that structural element to their growth in their patronage over time, then that gives us the opportunity to do very well over time. So they're the assets that we've tended to be overweight in that we believe are particularly attractive, and that's very much the case today. As I said, roughly 60% of our portfolio in those transport infrastructure assets, and that's the place where we continue to find opportunity.
Thanks, Gerald.
Thanks, Frank.
And thanks for watching, and as always, feel free to forward this link on to clients or colleagues where you think this might be of interest. Thank you.